2022 might bring a crash in the real estate market and the economy bigger than 2008. Well, at least according to a new theory that has some serious chops. I wonder if Michael Burry has caught on yet. In short, the theory notes that traditionally secure investments in commercial real estate have actually been propped up by volatile equities and securities. Basically, volatile and risky equities like stocks, derivatives, and other things have been unintentionally, or somewhat intentionally, tied to the illiquid and traditionally secure commercial real estate market. This might sound somewhat familiar, and it's basically similar to what happened in 2008. Let's dive in a little bit deeper, and we'll start with an analogy to understand what's happening. Before we do that though, if you do want to understand how 2008 happened and how something known as a mortgage-backed security works, you might benefit from watching this video here first. But let's jump into this analogy. Let's say you go to make a bet with a bookie that your favorite sports team will win a game. The odds of them winning are pretty high, so it looks like a sure bet that you will win. So because the bet is so certain, banks and lenders give you loans based on your expected payout. Say you put $100,000 into the bet, and if you won, you'd get $250,000. Banks, in this instance, would treat you as having $250,000 in the bank when giving you money, and consider it an incredibly secure investment too. After all, the bet is practically certain, and you basically have $250,000. The problem is, you don't have $250,000. You don't even have $100,000. You have a bet that will likely pay out. These are securities and derivatives. But continuing on with the analogy, historically speaking, this is probably okay because you could just get your money out of the bet by selling it to somebody else for a profit. Because the market is liquid, it has liquidity. This makes it relatively safe. If you lost all of your income streams to pay for the loan, worst case you just sell your bet to somebody else, taking it on, and get your money back. And you might even make a profit since the bet looks so certain. Someone might be willing to pay $150 to $200K for that bet that you only paid $100K for because they'd still almost certainly make $50,000 to $100,000 off of that purchase. But all of this is based on the premise that the bet is certain and the market has liquidity, or you can sell that bet. The loan you took out, looking good to banks, is based on that bet. Your net worth and creditworthiness is based on that bet. But let's say the team loses, perhaps unexpectedly in the last inning. You, all of a sudden, have no money, no capital. When your lender goes to examine your creditworthiness next month, which happens monthly in the commercial mortgage-backed securities market or the commercial real estate market, that loan would go from looking the best in the previous month when you had that great-looking bet to now that loan looking terrible. You would be the worst on the list. In other words, this is volatility in the mortgage market, which is supposed to be stable and secure. But how did this happen? Real estate loans are supposed to be secure, like I just said, and they're not supposed to be volatile. Well, the loan that you got from the bank was tied to a volatile bet. And this is what's happened. The volatile equities and derivatives markets are the bets. They're very risky investments and they could go up and down in a flash. And what's happened is banks that have these assets under their management, known as AUM, are leveraging those assets to get loans and investing in commercial real estate. They can take their expected value of the equities or derivatives, or even the propped up value of what it looks like then, the bet payout in the analogy we mentioned before, and use that like cash to get a loan. In other terms, these loans that banks are getting are based on margin in volatile equities. If the equities crash, then the rating of the loan does too, and the banks can't pay back their commercial real estate loans. Banks can often borrow with significant leverage too. Say get a loan for 200 times the amount of cash they have on hand, which again isn't actually cash. It's a derivative or an equity, a bet with high volatility. In that 200x number, that's actually the last leverage amount that Golden publicly published. That's based on reality. This is how volatile equities have essentially been tied to the values of commercial property. But shouldn't the banks and the rating agencies making sure that these are actually good loans actually rate them as bad loans so that no one would buy them and the interest rates would be through the roof? Well, sure, but that isn't happening. Even as some companies, derivatives, and equities, as the market's crashing, aren't paying out. We're not seeing the correlation between commercial real estate default and downgrades by the credit rating agencies. At least yet. So what's happening is these companies that might be terrible people to have loans with aren't getting rated as terrible companies to have loans with, and investors are snapping them up thinking they're very secure investments. This is very similar to the mortgage-backed security crash in 2008. A great example of this is Evergrande in China, which you probably heard of. They've defaulted several times on their loans, but the securities that their loans are in, the commercial mortgage-backed securities, they're not being downgraded by credit agencies. This is exactly what happened in 2008. The rating agencies weren't downgrading loans, they were falsely propping up the mortgage market, and when it came to light that that was happening, the entire market crashed in a flash. But again, everything I've just mentioned is just a theory. There's a lot of data missing here. And in fact, this was a pretty brief explanation of that theory. If you want to dive in even deeper, I'll link to the theory in the description below. I'll also link to a longer video by Andre Gic that goes over this topic in even more detail and gets into the nitty-gritty. And again, if you want to understand 2008 in the mortgage-backed securities market, you can watch my video on that topic right here.